Put $100,000 into VOO and the same amount into SCHD, the Schwab US Dividend Equity ETF, on the exact same day. Nothing else is added. Every dividend is reinvested. Then we let both portfolios run. Right now, Schwab would produce more than 3 times as much dividend income from that money. But over the 10 years ending in June of 2026, the S&P 500 grew at a faster annual rate. Using those historical returns, the VOO side would have ended around 423K, while Schwab would have been closer to 321K. One account paid more cash along the way. The other ended with roughly 100,000 more. So which one actually won? That depends on whether you're trying to build the largest portfolio, create income today, reduce the need to sell shares later, or simply own the investment you're most likely to hold when the market gets ugly. To answer that, we need to understand what each fund was designed to do and keep coming back to that original 100K. VOO is the Vanguard S&P 500 ETF. It holds around 500 of the largest publicly traded companies in the United States and weights them based on their market value. That means the biggest companies receive the biggest positions. So even though VOO owns hundreds of stocks, a relatively small group of enormous technology, communication, and consumer companies can have a major effect on its performance. VOO is sometimes described as a growth fund, but that isn't completely accurate. It owns growth companies and value companies. Its job is simply to follow the S&P 500 as closely and cheaply as possible. Schwab is built differently. It tracks the Dow Jones U.S. Dividend 100 Index and currently holds just over 100 companies. A company doesn't get included simply because it pays a large dividend. The index begins with companies that have consistently paid dividends. It then considers factors connected to financial strength, including cash flow compared with debt, return on equity, dividend yield, and dividend growth. So VOO asks a broad question. Which companies are the largest parts of the S&P 500? Schwab asks a narrower one. Which established U.S. companies combine a meaningful dividend with stronger financial characteristics? That difference changes the companies you own, the income you receive, and the type of market where each fund is likely to perform best. Now bring back the original 100K. VOO currently has a 30-day SEC yield of about 1.03%. That's an estimate of the annual income being produced by the fund's holdings after expenses. On 100K, that works out to approximately $1,030 per year. Spread evenly across 12 months, that's about $86 per month. VOO doesn't actually pay every month. It normally distributes dividends quarterly, but using a monthly average makes the comparison easier. Schwab currently has a trailing 12-month distribution yield of about 3.3%. On the same 100K, that's roughly $3,300 per year, or an average of $275 per month. Schwab also distributes its income quarterly, so neither investment creates a perfectly even monthly paycheck. But the first comparison clearly goes to Schwab. It produces roughly $2,270 more annual cash flow from the exact same starting amount. That does not mean it created $2,270 of extra total return. A dividend isn't free money being added on top of an investment. When a fund pays a distribution, cash leaves the fund and goes to the shareholder. Around that distribution, the share price adjusts to reflect some of that value leaving the portfolio. That's why total return matters. Total return combines the dividends you received with the change in the value of your shares. Suppose a fund rises 8% and pays a 2% dividend. Your total result is roughly 10% before taxes. Now suppose another fund pays a 6% dividend but falls 8% in value. The larger payout didn't make it the better investment. Your total result was still negative, and this is where the original 100K comparison changes. Over the 10 years ending in June of 2026, the S&P 500 produced an annualized total return of about 15.5%. Over that same period, Schwab returned about 12.4% annually. Those numbers include reinvested dividends. Compounded for 10 years, 100,000 growing at 15.5% becomes approximately 423,000. At 12.4%, it becomes roughly 321K. That's a historical difference of around 102K. The important word is historical. This doesn't prove VOO will beat Schwab during the next 10 years. The previous decade strongly rewarded the largest U.S. companies, especially mega-cap technology businesses. A different market could reward lower valuations, dividend payers, or sectors that currently have less influence inside the S&P 500. But it does show why choosing the larger dividend doesn't automatically create the larger portfolio. Schwab paid more income. The S&P 500 companies behind VOO, as a group, produced stronger total growth during that particular period. Now imagine the dividends weren't reinvested. The official total return numbers would no longer describe your actual experience. You would have received cash, but less money would have remained inside the account to compound. That's especially important with Schwab because a larger portion of its return arrives through distributions. During the building stage, reinvesting those payments buys additional shares. Those shares can then produce more dividends, which can purchase even more shares, spend the dividends, and you receive current income, reinvest them, and you give up that current cash to help the portfolio grow. Neither decision is automatically wrong, but they are two different strategies, and the next major difference appears when the market has a rough year. In 2022, VOO lost a little over 18%. Schwab finished the year down only around 3% on a total return basis. On the original 100K, that's roughly the difference between falling to 82K and remaining closer to 97K. That can feel enormous when it's your real money. Schwab benefited from having less exposure to some of the expensive growth companies that were hit hardest as interest rates increased. Its dividend-focused, value-leaning portfolio held up much better. And then the market changed. In 2023, VOO gained more than 26%, while Schwab returned around 5%. The fund that protected more money during the decline captured far less of the recovery. That 2-year stretch explains the trade-off better than simply saying one fund is safer and the other grows faster. Schwab can hold up better when the market turns away from expensive growth companies, and it can also fall behind badly when those same companies lead the market higher. And neither one is safe in the way cash or a government bond can be considered safe. Both are stock funds. Both can decline. Schwab may feel steadier during certain downturns, but companies can reduce dividends, entire sectors can fall out of favor, and the share price can still drop. There's also concentration on both sides, just in different forms. VOO owns around 500 companies, but because it's weighted by market value, a relatively small group of enormous businesses can drive a large portion of its results. Schwab spreads its money across far fewer companies and deliberately tilts toward dividend-paying, large-value stocks. That means it has less exposure to companies that don't pay dividends, including many businesses that are reinvesting heavily to grow. This can help Schwab when value stocks are performing well. It can also leave the fund behind during growth-led markets. So this isn't broad and risky versus narrow and safe. It's broad large company exposure versus a targeted dividend and quality strategy. Neither fund gives you international stocks, bonds, small companies, and every other part of a completely diversified portfolio. They are both different ways of investing in established U.S. companies. Now let's look at cost. VOO charges an expense ratio of 0.03%. Schwab charges 0.06%. On 100K, that's around $30 per year for VOO and $60 for Schwab. VOO wins on fees, but the $30 difference isn't the real decision. The differences in performance, income, risk, and investor behavior can move the account by thousands of dollars. Choosing the wrong strategy for your goals just to save $30 per year wouldn't make much sense. Taxes can matter much more than the expense ratio, especially in a regular brokerage account. Both funds distribute dividends, and those payments may create taxable income even when they are automatically reinvested. Because Schwab produces more dividend income, it can create a larger yearly tax bill in a taxable account. VOO normally sends out less income, so a greater portion of its return can remain as unrealized capital gains. Those gains are generally not taxed until shares are sold, giving the investor more control over when part of the tax bill occurs. The exact result depends on your income, holding period, account type, and how each distribution is classified. Inside an IRA or a 401k, the yearly tax situation works differently. But in a taxable account, receiving more income isn't necessarily an advantage when you don't need the money yet. Now we reach the part that often gets skipped. Suppose VOO builds the larger balance, but Schwab produces the larger natural dividend. Which one gives you more spendable money later? At the current yields, a $1 million VOO portfolio would produce roughly $10,300 per year in dividends. The same $1 million in Schwab would produce approximately $33,000. If your goal is to avoid selling shares and live mainly from distribution, Schwab makes that easier. But a VOO investor isn't limited to the dividend. They can create cash flow by selling a small number of shares. Some investors dislike that idea because selling shares feels like eating away at the portfolio. But economically, a dividend and a planned share sale are both ways of moving value from an investment account into cash. The important question is whether the portfolio's total return can support the amount being withdrawn over time. Imagine one portfolio grows to $1.2 million and yields only 1%. Another grows to $900,000 and yields 3.3%. The second portfolio produces more automatic dividend income. The first has $300,000 more in total value and can sell shares whenever cash is needed. That's why the winner can't be determined by yield alone. Investor behavior still matters. For one person, seeing quarterly dividends arrive may make it easier to stay invested. They can spend the cash without deciding what to sell, and the income gives them something positive to focus on when prices are moving sideways. For another investor, the larger dividend is simply taxable cash flow they don't need. They would rather keep the distribution smaller, reinvest everything, and focus on building the largest possible balance. A strategy that looks perfect on a spreadsheet is useless if you abandon it during the first bad market. Now return one last time to the original 100K. If 100K earns 8% for 30 years, it grows to roughly 1 million. At 9%, it reaches around 1.33 million. Just one additional percentage point creates a difference of more than $320,000. We can't know in advance which fund will earn that extra point. What we can understand is what each one owns and why their results may be different. VOO is probably the cleaner choice for someone with a long time horizon who doesn't need portfolio income today and wants a simple core holding tied to the largest U.S. companies. Schwab may make more sense for someone who values higher current income, prefers a large value and dividend quality tilt, or knows regular distributions will help them remain invested. Owning both can also be reasonable, but it's important to understand what that actually does. Many companies inside Schwab are already held by VOO. Adding Schwab doesn't suddenly diversify the portfolio into a completely different type of investment. It increases the amount invested in dividend-paying value companies and reduces the relative influence of the largest growth-oriented businesses. And that may be exactly what you want. It just needs to be a deliberate decision, not an assumption that owning 2 ticker symbols automatically gives you twice the diversification. So which one wins? For current dividend income from the same 100K, Schwab wins easily. For total growth during the 10 years ending in June of 2026, VOO won by a wide margin. During market declines, the result depends on what is causing the decline and which parts of the market are being hit the hardest. In a taxable account, VOO may have an advantage when the additional dividend income isn't needed. And over several decades, the better investment may be the one that matches how you plan to use the money and that you can actually continue holding.